As we told you at the top of the hour, the International Monetary Fund, the I.M.F, boosted its forecast for the world economy today. For more on the I.M.F's report, we're going to go back to Washington and Bloomberg's Peter Cook, who is standing by with the fund's chief economist. Peter?
Eric, thanks very much. Joined now by Olivier Blanchard for a first on Bloomberg interview to discuss the IMF's latest update to its world economic outlook. First of all, thank you for the time. We appreciate you joining us here on Bloomberg.
Thank you for inviting me.
The message from the report today, this recession is not over, but you do see things starting to improve.
You got it just right.
No, interview's over. No, please provide some more details.
You're completely right, which is that we think the global economy is still in recession, but recovery is coming. In terms of the basic numbers, the forecast, we still have a negative number for 2009. We have minus 1.4% for 2009, but we have a positive number for 2010, namely 2.5%. So compared to a forecast last time, we're a bit more optimistic about 2010, roughly 0.6%.
More optimistic about 2010, and that's a reflection of all the extraordinary government interventions we've seen, the macroeconomic policy, the fiscal policy, the monetary policy interventions we've seen?
Yeah, I think it's a result of all these things. Also return of risk appetite and a number of things that we were not sure would come in time. So yes, we're a bit more optimistic, but I mean, one has to keep it in perspective, right, which is that 2.5% is still far below the kind of growth rate you need to maintain unemployment constant. So this means that throughout 2010, we still basically predict an increase in unemployment. So it's good news, but it's not great news.
Good news.
Weak recovery is one way of putting it.
A weak recovery. Some green shoots out there, but you're not seeing a full-blown recovery at this point.
Yeah, I'm not sure that the green shoots analogy is very popular. I don't think that's the way to think about it. I think there are things which are pulling the economy down, things which are pulling the economy up. The balance is changing slowly, so you may see green shoots here and there. I think the fundamental dynamics are going in the right direction. I think the main problem is really how are we going to have a strong recovery, and something which decreases unemployment at some point, which we need to do. Right?
What about specifically in the United States? Let me get you to isolate the United States, because there, again, is some modest improvement in your forecast for the United States in 2010, 0.8% growth as opposed to flat. Tell me what you see going on in the United States.
Well, if you look at where we think the recovery is going to come in the U.S., it's going to come partly from technical factors. Firms had decumulated inventories. They're now rebuilding them slowly, so you get an increase in production. That's good, but it's not going to give you 5 years of growth. It's a very useful thing in the short run. But much of the pulling is going to be done by fiscal policy. As you know, we've spent relatively little of the fiscal stimulus so far. It's really coming online, in the rest of the year and early next year. That's really going to be doing the pulling. Now, to get a really strong recovery, you need consumption and investment to start kind of going up, the demand for housing, the demand for cars. And there, we don't see it yet. So that's why we have, better news, but again, a weak recovery. I mean, less than 1% is nothing to boast about.
And what about it, even here in the United States, there's a great debate as to whether or not the stimulus that it's been put in place, whether or not it's adequate enough to do the job. What do you make of that debate here in the United States? And globally, there have been concerns here in the U.S. that maybe other countries weren't doing enough on the fiscal side as well.
Yeah, I think we have to be ready to accept the fact that maybe private demand is not going to come back quickly, in which case, something has to be done. And so the notion that we may have to have fiscal stimulus for longer than initially intended is something that at the fund we had always said, think about, it can happen, you may need to do it. And I think it may be true for the US, it may be true for other countries. Now, the great danger is if this is the only thing you do, then markets are going to go berserk. So you actually need to do what the Obama administration is thinking about and other countries are doing. You need to do reforms, fiscal reforms, which make the more distant term, the next 5-10 years, look better. So reforms on retirement, reforms on healthcare. I think you have to do both. You really have to both be willing, be ready to spend more now, because it may well be needed, but you're not going to get away with it unless you also do something more structural, more fundamental, reforms of healthcare, retirement.
And there's a significant discussion in the report today about exit strategies. Countries need to start talking about their exit strategies.
Right. So it's too early to exit. I mean, at this stage, we still need basically to put the fiscal spending in if it's needed, to keep interest rates very low. to take care of the financial sector, but we have to think about later. And given it's going to be so complex and so important to put in place, we actually have to think about it now. We don't have to do it now, but we have to be ready. When things improve, we have to be able to go away.
All right. And Olivier, if we could, we're going to ask you to sit tight here. We're going to continue our discussion with Olivier Blanchard, Chief Economist of the International Monetary Fund, talking about this new report, Economic Assessment of the Global Economy, the U.S. economy, around the world, what's going on with the economy. We're going to be back in just a moment to ask about some of the risk factors going forward as we consider the financial crisis and the worst recession since World War II. Back after 2 minutes. I'm Peter Cook here in Washington. We're back now with I.M.F. Chief Economist Olivier Blanchard. The I.M.F. today releasing its latest update for its World Economic Outlook, also its update on global financial stability. Thank you for staying with us here on Bloomberg. I want to ask you what worries you most. As you submit this report, you do say the risks are still tilted to the downside. Maybe they've improved somewhat. What worries you the most?
So I think at the world level, the issue is at this stage we've been propping the economy up, hoping that it would naturally lead consumption investment to go up. Now, whether this actually happens, I think, is one of the main issues. And if it doesn't happen, then can we continue to prop it up for very long? I see this as a big worldwide issue and a difficult one. Now, when you look around the world, some people are doing better, some countries are doing better, some countries are doing worse. Asia is doing better, largely because China and India have been doing better. They have been taking very strong policies, and they are having an effect on the rest of Asia. But as you know, there are parts of the world which are not doing great. Western Europe is not doing great. Partly because Germany was very export-oriented, which is a good thing in good times and a bad thing in bad times, so they're suffering a lot. Because Europe relies very much on the banking system as a way of intermediating funds, and the banking system is not in great shape. So there you can think of things going bad. And then, as you know, there are some countries, not all countries, but there are some countries in emerging Europe which are really in trouble.
Let me ask you one aspect of that. That's in this report, you suggest that some economies, the United States, for example, is going to have to focus more on its current account deficit. Exports are going to have to drive more of the U.S. economies. Does that mean the dollar is going to have to depreciate more?
I think that when you look at what has to happen to the U.S., you say, where is demand going to come from, right? And consumption is going to be weak because the consumers have learned a lesson, and so they're going to save more. Investment is going to take a long time for it to actually go back to normal. So if you want to decrease government spending, then, by the virtue of accounting identities, what you have to do is improve net exports. And so I think, yes, part of how we're going to get back to global growth is by basically decreasing the current account deficit of the U.S. and by implication, the current account surplus of the other countries.
All right. Well, listen, we're going to have to leave our discussion there. Thank you very much for joining us. Olivier Blanchard of the International Monetary Fund joining us here in Washington. Eric, I'll send it back to you in New York.
Thank you very much, Peter. Great interview.